The webinar is live on YouTube. You can start.
Shagun, you can start.
Okay, good afternoon, everyone. It is our pleasure to welcome you all to today's session on Startup Valuation 101. We are honored to have with us Mr. Arpit Parekh, a seasoned chartered accountant with over 15 years of experience. He is a registered valuer with the IBPI and has pursued entrepreneurship management from XLRI Jamshedpur. Mr. Parekh has been a trusted advisor to several startup and incubator. He formerly served as vice president, investment banking at Hcon Global Services Ltd, where he played a key role in M&A, debt uh, syndication, and startup fundraising. And in addition to his corporate expertise, he has also founded two startups himself, namely Adyan Greens in green tech energy space and Edwell Solution in edtech. He has done valuation more than 300 startups and companies across various domains and sectors with combined valuation more than of 10 crores. Mr. Parekh brings a wealth of practical insight of today's discussion. So over to you now.
Thank you. Thank you. Just one correction. It is 10,000 crores of worth of value of the entire thing. So thank you. Thank you very much, Shagun. Thank you, Utkarsh, and the entire team at SIIC IIT Kanpur for having me here. I'm sure all the startups always have this question of, valuation as to what is that one should be valued at, and how to arrive at some valuation before going to any incubator or any investor. And I will throw some lights as to what are the current trends that are going on. And I will also provide you some understanding as to how to go about with it. So I will share a presentation with regards to the same. Yeah, I think it's visible. It's visible, Shagun?
Yes, it
Yes,
is.
sir, it is.
Okay, okay. So great. Welcome everyone once again to Startup Valuation 101, conducted by SIIC Kanpur. Thank you very much once again for having me here. Let's straight away get into what is that we have to, and why is that we have to do valuations, right? So the most important thing that whenever startups, especially in need of capital, right, will always go to investors, and that is basically for all the fundraising activities which all the startups and promoters will have to go to all the incubators and to the venture capitalists. For that particular reason, always the straight question which will be asked maybe at the end, after all the due diligence and everything is done, as to what is that you are expecting your value to be about, right? And I have seen promoters and founders coming to me with valuation requests running into hundreds of crores, even though they might have just started based on all the IPs and patents. We'll just run across as to what actually will will help you to cross the bridge, because it is not always that you might be valued at 100 crores. Initially, you will have to go step by step, wherein dilution will also play a big role whenever you are doing your fundraising exercises. So the most important thing why valuation is required is for all your fundraising requirements. That is the proposed investor negotiations. Similarly, once your funds are raised, there are compliance requirements, wherein there are certain acts under which we will have to submit valuation reports to the statutory bodies, and we'll brush upon that also. What are the requirements and what are the ways in who do you have to contact for that particular compliance requirements as well, right? So going ahead, so what are the various approaches and methods that we as valuers generally adopt? Even if you do some simple Google, you will get these answers. We'll try to delve a bit more into some practical details also. So let's go first into the various approaches that are, the first is the asset approach, that is the basic or the base value of any company. You can say that that is the amount invested, and if there are any losses minus that, will give you that base value. That is the value below which no transaction will ever happen, because basically you are saying that this much amount is already there in my books of accounts, right? Then why will anyone want to do a transaction below it? So this is the base minimum value which anyone would like to adopt. Second is market value approach, market multiple, as very commonly known. Comparable company method, one of the jargon which is used. So this is plainly to say that if a flat I want to buy next to me is quoting at maybe 10,000 rupees a square feet, right? What should be my if I am buying a flat next to it, what should be the value of this flat or the price of this flat, right? If it can have adjustments for it might have a sea view, a garden view, a swimming pool view, there might be adjustments to it, and accordingly basically you will have your own value. So similar to this, for example, you are into cyber security domain, you are into defense technology, you are into some other healthcare or health medical equipment technology, you will have to understand what are similar companies within your own framework, right? But don't always compare with them apple to apple, because what happens is whenever they might have, if they are raising today for example at $100 million, that doesn't mean that even you will be valued at the same rate. What needs to be understood is that where were they, how much valuation did they command when they had actually at your stage, right? So that is how you do an apple to apple comparison with the market multiple approach. Then we have a one more approach known as income approach. This is the most famously used approach, known as the discounted cash flow. This is basically the projections which we always take from all the founders to understand your business plans, to understand what are you guys going to actually pursue whenever you are going to go into the markets. So this is one of the very important approaches for us to even understand what business you are going to do, what costs you are going to be incurring, whether you are going to be a capital heavy business model or capital light business model, whether you will be a working capital intensive model or a working capital light model. When I talk working capital, it basically means receivables, inventory, payables, that is called working capital. A lot of times, if your business model is more on the B2B side, right, then you will always have working capital requirement, and always you will be needing to raise funds in order to fund that working capital. So we study the entire model, right from your revenues, the growth rate of the revenues, how are you going to judge that, right? Even that is very critical, right? It is not that okay, you will just give us some numbers and we are going to do a simple arithmetical calculation out of it. It is not going to be like that. We are going to apply our own judgments based on our experiences, based on similar industry financials, right? For example, if you are an IT company, we will try to see what other IT companies EBITDA margins are going on in the market. If you are saying that I will be having a 60% EBITDA margin, and even a mature company is going to have just 25-30% EBITDA margin, you will have to give a very strong reason why that huge difference is going to be, right? So whenever you are giving any projections to the promoters, whenever you are giving any projections to investors, be understanding that each and every number of that will be questioned by them, right? It is not that simply on paper we are going to take your numbers and we are just going to do our arithmetics Excel file and going to give you out with the valuation reports. That is not how we are going to do it. We are going to literally, sometimes if you go to VCs, incubators are much better off, but VCs, if you go, they will grill you even for a small growth rate, because they are going to be investing in you a much higher amounts and probably at a much higher valuation also, right? So a VC will grill you much more on every number that is going to be presented by you to them, and hence be very mindful as to what projections you are going to give to any valuer, right? Similarly, with respect to assumptions, whatever assumptions you are giving with respect to that sales projections and costs breakups, right? All of that again we will be doing and comparing with other similar companies. And if we are saying that no, my employee cost will only be 10%, whereas a bigger company might be having 30-40% as employee cost, it doesn't sound right. So whenever we are projecting, see, we understand that you are not able to project more than 1 year righteously, right? But whenever you are projecting the future years also, be mindful that whatever you are projecting, see similar companies in your domain. Do some study, do some homeworks, right? Because whenever you are doing that, only then the investor will understand that you have done something and you have come with some homework. Otherwise, he will just throw your papers away. If you see the success rates that an entrepreneur has in front of VCs is probably just 2%, right? And the good thing is incubators have a much higher success percent, right? If you are going to present to incubators, maybe 10 to 15% will be the percentage by that you will be cleared, right? But that is the reason you will see the valuation also which is given by venture capitalists is much higher, and what is given by incubator is always much lower, because we whenever as incubators, if valuation is done, we always see that okay, we are there to promote you, we are there to handhold you. That is the basic idea, right? And that is why the valuations might be lower than what you might see with comparable companies in venture capital transactions, right? So this, and whenever you are giving these projections, this has to be very much scrutinized by yourself first, so that whenever the VC is asking, you are not fumbling and all of that, right? It is very important that all the numbers are understood by you thoroughly, even though it might have been prepared by your chartered accountant, it might have been prepared by your some financial advisor, but you have to have all the numbers understood whenever you are presenting it to the investors. The reason I'm emphasizing on this is because this is going to be the major method under which all the incubators and even VCs will try to value you, right? Then we have a VC method. I will come to that. I have an Excel file as well, wherein we will just browse through how these different methods will play, right? And finally, I have a method which I always call "Mujhe kya lagta hai" approach, right? So this is basically, I always see a lot of founders coming to me that sir, मुझे तो लगता है कि मेरी कंपनी की वैल्यूएशन तो 100 करोड़ रुपया होनी चाहिए. I mean, I don't see any time I have not got this answer, right? I see Utkarsh also smiling because we both have gone through the same things, right? So it is a very normal thing. Even if I would have been on that side of the table, even I would have come up with some number, throwing some basis, right? It is always good to do that, but we should understand one thing, that that figure should not be very distant. If you think by all the other methods, your valuation is coming somewhere around, maybe some, take an example, 10 crores, and if you are saying that my valuation will be 50 crores, the bridge is very big, right? It will be very difficult for anyone to bridge that gap, right? So it is better that if you feel that out of all these methods, the highest is maybe 10 crores, maybe you can start with 15. There, no one is going to stop you, right? But if you start with 50, it will just turn off everyone that, okay, nothing is possible here. So it's better to leave the entire deal here, right? So whenever you are quoting that number, you quote on a higher side, absolutely fine. I also advise whatever startups we do, you always be on the aggressive side, because negotiations are going to happen. It is understood by them also, understood by us also. But don't keep the gap too high that someone is just going out of the table, right? So these are the basic methods. Let's also briefly understand these. I will just share Excel file so that you can understand it a bit better. Okay. Okay, now we have this Excel file. Basically, I have tried to put all the methods in one sheet so that it is easier for us to understand. So for example, the first file is called the NAV, or the NAV method, which we looked upon as the base value, right? So you are seeing this company wherein there are some plant and equipments of 15 lakh rupees, intangible assets, product development of almost 50 lakh rupees. See, we understand all the initial companies, the IT, cyber security, or anyone who is coming out with new technologies, we understand your major spend is going to be on product development, right? And that is why you are capitalizing here. We will finally see how are you going to utilize that product development going future, right? Though in this method, we are seeing that, okay, 15 lakhs of some plant and machinery, it can be even laptops, some high-end servers and all of that, some product development expenses, right? Trade receivables is basically, I always say a lot of times, sometimes with especially technology guys, what happens is they always assume that if it is sold, you have received the money. It might be true in case of SaaS companies wherein you are billing them upfront, But in most of the cases in B2B companies, please understand, they are going to make the payment after you have given them a service or after you have done a billing to them, right? And it takes in a standard 15, 20, 30 days for anyone to, release that payments. So you have to take that into account, because that is very critical for your funding requirement. Because a lot of times people come to me and show me financials, everything is you are making profit from day one. But then I always ask them, if you are making profits from day one, why do you need the money? They need the money for funding the working capital, because your money gets blocked in receivables, similarly in inventory, right? I mean, a lot of manufacturing companies, medical tech, defense tech, you will have a lot of inventory in your books. It is not always going to be a make to order kind of a situation. You will have to stock certain things. Once the order comes, you might have to ship certain things instantly. Certain things you might make based on order. But similarly, you might also have some raw materials which are ready, because a lot of times we see that inventory and everything of high end goods you have to import. So for example, if it is a make to order thing and if you have to import from China and if it is going to take 45 days or 60 days, when are you going to fulfill that order, right? So you have to understand that you have to do a proper assumption of this receivables, inventory, and similarly payables is, for example, salaries and everything, you generally make payment at the end of the month. You don't make it front. It is not a on the first that you are making the payment to your salaries, right? So you get these assumptions very properly, so that whenever you are running a cash flow model, you understand exactly what is going to be your fund requirement, right? So here we are seeing 3 lakhs of trade receivables, 15 lakhs of inventory, 37 lakhs lying in cash and bank, and some other current assets. This may be some GST receivable or something like that, which are always lying in the books of accounts. Similarly, this company was funded by almost 1 crore rupees of capital, right? 35 lakhs is reserves and supplies is negative. This might be because a year past, there might be some losses which might have incurred into the company. That is why this is a negative figure, right? This is a general thing in all the startups which we see. That is why I have given a negative figure. If we see a mature company, this figure will never be negative, right? However, since all of you guys are your startups, I want to emphasize this. This is very normal and this is very acceptable also. So don't worry if your reserves and surplus is going negative, right? Similarly, so how have you might have funded through your own unsecured loans, or there might be CCDs which might have been provided by some institutions or incubators. So that will come in borrowings, and you have some trade payables and current liabilities. So if you see your net asset value is a total of all of these assets, that is 1 crore 22 lakhs minus your current liabilities and your borrowings, that is going to be 65 lakhs. That is, so basically what does this say? That the minimum value of this startup has to be 65 lakh rupees. I cannot, as a valuer, it will be wrong for me to even go below 65 lakh rupees. So this is the minimum value that you have got. Now let's go ahead and look upon what is a market approach, right? So in market approach, there are various multiples that are generally provided, right? In early stage companies, we don't look at profits because we understand that profits is going to come on later in maybe year 2 or year 3, right? But initially we understand, because you are going to be a loss making company, we will take certain ratios which are not linked to profits. For example, the most common ratio which is used is price to sales. That, okay, you are at sales of this much, the current company's valuation is X, and that is how the price to sales is coming at, right? So price to sales, price to GMV, you might have seen bigger companies like Flipkart and Amazon, and so marketplaces generally, which, if you are a marketplace company, then you will be more having a price to GMV kind of a market approach. Then price to EBITDA, this is a profit multiple. This is for a more mature company, right? Price to book value, certain times, certain companies, if you are investment company or, fintech company wherein you are going to hold a lot of investments in multiple startups, then price to book value comes into play. Then EBITDA per ton, for example, cement companies or heavy machinery companies, we look at EBITDA per ton as one of the methods. Then hospital beds, in case of medical companies, hospitals and all of that, recently a lot of transactions are happening in the hospital side. So there it is always price per hospital bed. That is how it is being understood as a market approach. So for example, I have done a simple understanding. There are four companies, right? Company A valuation is 100, second is 50, fourth is 400, third is 400, fourth is 1000 rupees, right? Sales were roughly around 10. So if you see, these are all maybe of different stages. See, generally, the earlier a startup is, you will be having a crazy multiple, right? It can be 20x, 30x, right? But the more mature you become, you will come into the standard funnel. The standard funnels are 3 times, 4 times. So if you see, for example, this is rupees in crores. If this is a 1000 crore valuation, the sales are just 300 crores. Whereas your 100 crore valuation for a 10 crore sales startup, right? The price to sales are so different. Why? This is a more mature startup. The growth rates might not be the same now for this mature company than what it will be for a startup company, right? For startups, generally we talk in X. This will grow in 2x, 3x, 4x, right? Whereas in mature companies, we talk of growth percentages like 10%, 15%, 20%. So that is the reason their price to sales are generally lower, and the startup companies valuations are generally at a higher price to sales. So if you see, whenever you are going to an investor, right, you will always have to command a higher price to sales than a lower price to sales, because you cannot compare yourself with a very mature company, right? But this again will come later in the VC method. I will talk about the mature price to sales, how it comes into play, right? So this is basically how we do it. We take an average of all of these companies, right? Because we will have to see all the stages of the companies. We will take an average. For example, in this case, it is coming at 10.58 price to sales. I will further discount this. It is again not the same. You might not be at the same stage, right? That is why we will always discount it for management. For projections, you might have given some great projections, we will discount that again, right? And for the size at which you are, right? So for example, if you are at a 1 crore sales, I may not apply you the same 10.58 crore price to sales. I will give you a lower one because you are still at a lower size, right? So that is how we will try to give valuation to the startup companies. So this is how market multiple approach is very widely used, right? Then we come to DCF method. As I told, this is the most widely used method, right? You have to be very mindful of what projections. I have even drawn some projections here. All these projections have to be given very well thought about, right? Please include all the expenses. I see a lot of projections coming to me without even marketing expenses. Sometimes people say, sir, हम खुद से marketing कर लेंगे. If you are doing everything by your own, the growth rates are not going to be the same that it would have been have had you had a marketing partner, right? A lot of times people go out of India and do their sales. It's commendable, but understand certain times you need to have channel partners, and all of these are not going to come for free, right? So you have to account for all these marketing budgets, especially in technology companies. You don't think that my technology is superb, I don't need to market myself. Please don't be so naive. You have to include, you have to go to exhibitions, you have to meet a lot of people, there might be commissions involved. Have some basic 15-20% as your marketing budgets, right? Direct expenses, always you guys will know. Employee expense, again, please don't under budget yourselves. I have seen today people coming to me with projections wherein the developers and everything put salary of 50,000, 70,000. Honestly, we don't get good developers at that salaries, right? Please go to the market. If you don't go to the incubators, they will help you to understand what are the current market salaries that are going on, right? A developer, you won't get minimum, less than 2 lakh rupees. So don't under budget yourself. Otherwise, you will only have a problem because you will have to again raise funds whenever you want some senior hiring or something like that. Budget for all of that so that, your projections will look more real. We know it will be, it is not going to be exactly the way the budgets and the real scenarios are going to be, but at least we can apply our some minds and try to be as near as possible, right? So Direct expenses, employee benefit, R&D. Again, I see a lot of companies coming to me, especially technology companies. You guys put all the cost of goods sold and everything perfectly, but what about continuous R&D? You are going to not stop at one project, right? You are going to do again and again and again. So have proper R&D expense being put into your projections. And finally, admin expenses. See, there are whenever you are doing working of your projections, rent cost will be there, electricity cost, you will have employee benefit expenses, you will have CA cost, accounting cost, legal cost. These are all costs which you think, but they are not nowadays. Nothing is coming very in a minuscule amounts. You will have to project it properly, so that again, even if there is any, see, I will always tell my startups, always budget higher. Usme se kam hua, that is always perfect, that is always okay, right? But don't think that, okay, I will just keep 2 lakh rupees for a legal expenses for my whole year, and I am going to do fundraising at least 2 times in a year. It is not going to happen, right? So be mindful of what you are projecting perfectly as near as possible, right? Depreciation is basically, you generally take 3 years or 4 years of your capex. Again, capex is going to be an item which you will have to project. Properly projected. I have seen instances recently, one of my startups, we had projected roughly around capex of 3 crores. Finally, at the end, we had to actually spend 10 crore rupees, right? A lot of times what happens, we think हमने ये कॉलेज में बना दिया है, ये हम लोग को अराउंड 50 lakhs 1 करोड़ में हुआ, तो बड़े स्केल पे जाएंगे तो 3 करोड़ में बन जाएगा. प्लीज डोंट थिंक इट इन दैट वे. मेडिकल का medtech companies, you will have to do a lot of clean room fittings and all of that. I mean, so many things have to be understood, especially if you are going to be for US FDA or even ISO certifications. There are so many changes that they want whenever you are setting up a plant. So try to study it properly instead of just putting up a number. If you are just putting up a number, it will be questioned again and again later on if you are not, if you are not going to complete your exercise within that budget, right? So it's better you always consult some people who are in the industry to know exactly how much, for example, if you had done something in a GMP facility in a college, how much it will take to, do a large scale production or large scale facility in some other setup, right? You will have to understand that there are many nuances. You will have to involve a lot of advisors. Again, take the help of whatever is available with incubation system within your own network, right? It will help you a lot. And we talked about inventories, receivables, payables. So these are all the working capital requirements which has to be understood by all the startups. With respect to tax, again, it is very much required. Today in India, we pay 25% as tax. If you are a new setup into manufacturing, you might have benefits of 17%. If you are registered with DPIIT, and also if you have a section 80 IAC, that is a very specific exemption certificate, you have to apply for it separately. Please note, a DPIIT certificate plainly does not entitle you to that exemption, right? You have to apply for it separately. It's a beautiful scheme wherein you can get 3 years of tax holiday continuous out of a 10-year window. There are some conditions, but most of it is all manageable. So I always request all those who are listening to me also, if you have not applied for a section 80 ISC certificate, do it right now, because it is, as it is going to be starting from the day of your incorporation. Even though you apply today or later, the entire 10-year window will start from your date of incorporation. So it is always better to get that exemption. So so accordingly, project your taxes also. Taxes play a big role in your valuation, right? Because if you are going to get some exemptions in that, your valuations might shoot up tremendously, right? So if you see these projections, this is finally the DCF slide. If you see, this is how it is finally. The cash flow statement is always a derivative of the projections, right? So that is why we always emphasize, project properly. Your DCF will throw a much better picture, some understandable picture which even you will be able to digest, right? And basically DCF is nothing but all your cash flows we take and we discount them at a particular rate. Now let's talk about rate. Generally, VCs, PEs would want a rate not below 30%, right? Because if we say today, let me give you an example here. This is my WACC calculation also. This is for a bit mature company. But for example, today the risk-free rate in India, this is the 10-year bond rate, is roughly around 6.5%, right? Uh, Add to that the equity risk premium. What is the equity risk premium? If you would have invested that instead of fixed income, if you would have invested that into a Nifty or a Bombay Stock Exchange, any companies, right? Mature companies, the rough yields over the years, don't count me, I mean, don't hold to me for the last 1 year or something. We have had negative returns. But if you see a much larger picture, right? 10-year window is generally being taken to understand at what an economy's risk premium, equity risk premium is. We have generated a delta of almost 7.5%, right? So if you see the combined yield, it is roughly around 14% is what I would have got had I invested in mature markets like stock exchanges. Then why will I invest in a startup, right? If someone is promising me just 14-15%, that is the reason. And there is a beta. Beta is basically how your required rate moves based on the industry you are in. So for example, here I have taken a software system, and beta is basically similar companies, how they have moved across the years. So it is 0.88. Beta is basically how you are moving vis-a-vis the stock markets, right? So 0.88 is how they have been moving. So finally, if you see that my combined cost of equity was 13%. The minimum, this is more mature company. If I would have done a startup company, I would have added minimum 20%. And you see the minimum returns that are going to get, it will be not less than 30%. Again, a lot of startups come to me with their own valuation reports, wherein they have done a weighted average capital cost of 20%, 25%. Please be mindful, sir or madam. This is not going to be like that, right? Anyone who is going to invest in startups, especially at early stages, will be wanting minimum 30% returns, right? So whenever you are discounting your cash flows also, please do that accordingly. So that is why if you see here, the discount rate roughly around 30-33%. The growth rates, these are perpetual growth rates. Some may argue, sir, we are startups, we are growing at 15-20% even after third year or fourth year. I agree. But when we talk of perpetuity, perpetuity is a much longer tenure, right? Generally, a 20-year tenure is what we look at it. So at that scale, you are not going to grow year on year at that rates. That is why we always take perpetual growth rates roughly around 3 to 4%. In mature markets like the US, they take just 0.5 to 1%. Right? That is the standards, global standards, and that is what we have adopted. In India, we have generally 3 to 4%. So this is how, and finally, when you are discounting all your cash flows to today's price, based on this returns, the finally you are going to get some value. For example, in this case, you are getting 1120, that is 11 crore 20 lakh rupees. So that is what you are going to get, right? So this is the most used method and most scientifically and mathematically proven method. However, the problem is with the inputs. I have seen people put inputs in such a way that they straight away throw the outputs which they won't desire, right? इट इज लिंक टू द मुझे क्या लगता है अप्रोच. तो अगर मुझे लगता है कि मेरा वैल्यूएशन 50 करोड़ है, तो मैं मेरे वैल्यूअर को ऐसे नंबर्स दे दूंगा कि वो ऑटोमेटिकली उसको भी पता है कि वो भी यही नंबर्स डालने वाला है, राइट? सो we have to be understanding that whenever you are giving data to us, we are going to discount it in a proper way, understanding what industry you are in, similar companies, how they are operating, and how is the overall economy also operating, right? So this is how DCF method is done. Now let's look at VC method. This is a very interesting thing, and this is the reason also why VCs value you guys much higher than what I will say as an incubator anyone will value you guys. So how does a VC generally see? VC will say, okay, I feel the business model is good, everything is fine, the management is good. He will grill you a lot on your projections, and he will want the main figure out of that projections. That may be, for example, in this case, I have taken price to sales, right? So I have done it is like a mix of various methods. So first I will freeze the numbers. First I will understand what were the projections given by the entrepreneur. They will literally burn the entire numbers being given by you guys. They will again plot their own numbers based on their experience, right? And then they will finally understand the industry. They will talk to some industry experts that, okay, if my people are proper, if my technology is correct, will I be able to achieve this number? And if possible, after that, they have achieved that, okay, at the end of 8th year. Now, why I have taken 8? Generally, a VC cycle, a VC cycle is for 7 to 10 years, right? They will want exits after 7 to 10 years. They are not in your company forever. Please understand that. They also have taken money from some people to whom they have promised certain IRRs, right? Some rate of returns, and they have to return that money back to them. And generally, this scheme, it runs for around 7 to 10 years. So that is why I've taken on a pessimistic side. Maybe at the 8th year only he wants an exit, right? And so in fact, that is a reason why you are seeing a lot of IPOs being coming recently of all the new age startup companies. Recently, Lenskart has also filed for an IPO. Zomato has, I mean, there has been a list of IPOs by all the new age technology companies. The basic reason you will see, none of them are taking money in the company. They are all offer for sale. Offer for sale means all the VCs are exiting, right? No money is going back into the company. All the money is going directly to the venture capital, right? So for example, here, if I am a venture capitalist, I feel okay very positively. This company at the end of 8th year will do a turnover of 100 crores, right? Now I showed you the market approach also, right? But when I am, he will come here and compare that. He will not take the new age startups. He will go for the mature, because at 100 crores you have been now a mature company. Now he will compare you only with the mature. So out of the entire lot of maybe 8-10 companies, he will dissect you only and compare you only with the very mature companies and see, okay, the mature companies are being traded today at an average price to sale of 5, right? I told you, if you are a startup, you might be at 10, at 15, but once you mature, your ratio will come down gradually because your growth rates will also come down, right? So he will see, okay, at that time, basically today all the mature companies are trading at a price to sales multiple of 5. So basically at the end of 8th year, I will get this company to be valued roughly around 500 crores, right? The discounting rate, the IRR, what the VC wants is, for example, 30%, right? As I told you, they want a minimum of 30%. Suppose he's wanting 30%. The tenure he wants is 8 years. So what will be the valuation today of that 500 crores? That will be, this is an Excel formula, that is why it is showing negative. Basically, it is 61 crores will be your valuation today, right? Up if he wants a 30% IRR at the end of 500 crore, at the end of 8 years, right? So 500 crores will be valued at 60 crores today. And second thing, he will generally not invest lower than 15%. All VCs, they always want minimum 15, 20, 30%, right? So if I want to invest 20% in your company, this is the amount of funding I will be doing to this company. This is how they build up, right? This is unlike an incubator wherein we know that we are going to invest 50 lakhs, 1 crore, 2 crore rupees in your company, and based on your projections we will try to arrive at a particular valuation, and we might not be taking more than 5-10%. Not more than 10% is what I have never seen incubators taking more than 10% for fund infusion, right? So having said that, so the basic ideologies of both of them are very different, right? And that is why I always promote all my startups that first go to an incubator, because they are going to give you money at a much cheaper cost, right? Because they are not going to be very much dilutive, right? And take yourself to the second lap of your journey and then go to the VC, because then he will be able to provide you a much better valuation, because finally he's going to dilute you by 15-20% minimum. Then why not go when you have always become more mature, right? So this is how venture capitalists will do their valuation. However, each of these numbers, he might take at least one month to come to even these numbers, right? The first number, in fact, he might take 2 to 3 months just to arrive at the number that what will be the sales of this company at the end of 8th year. He will do a lot of diligence. He might do a lot of snooping also, right? I have seen a lot of VCs doing a lot of snooping into a lot of, they will send a lot of their employees or some spies to you guys to just to understand whether you are actually doing what you are thinking, and whether the end user is actually using your product or not. So don't think it in that way that a VC or someone can be fooled very easily enough, right? He will be doing a very thorough due diligence before investing in your company, right? So this is how VCs generally do valuations, and that is the reason again VCs might generally be giving you higher valuations also. So I think this is what it is about the methods of valuation. Let me now again jump to some more discussions on valuations. Uh, yeah. So basically, let me give you some benchmarks. I'm sure everyone would like to know. Okay, sir, ये सब तो ठीक है. हमारे valuation, हम whenever we are going to any incubator or anyone, what is that we should take, right? What is that we should expect, right? See, whenever you are going to first understand which stage you are at, right? This is all. This what I built is based on my entire experience of having done almost more than 300 startups now. But I have seen at every stage you will be differently valued, and the methods in which you will be valued will also be very different, right? So, for example, here I have started with, if you are a pre-revenue startup, right? Just ideation stage, right? And you are going to an incubator. The wonderful thing today is, gone are the days when you had to go to your friends and family and ask for capital, right? Today you have wonderful angels like incubators who can very easily fund you and give you not only equity secondary. I will also suggest all of you go for grants. There are so many government grants which are being provided by the incubators. So first always go for grants. Once that is being done, then you start raising some equity in your company. Whenever I have seen, this is again based on my experience, whenever you are going to any incubator, they will want somewhere in the range of 5% to 10%. General ranges are 25 lakhs to 50 lakhs. In fact, recently I am seeing incubators even investing higher amounts up to 2 crore rupees. Again, thanks to the government support, they are increasing the quantum of funds that are being deployed now, right? So at this stage, don't think, yeah, I have just, I have a wonderful idea, I have patented ideas, I have trademarks. All due respect, please don't value yourself too high, that as incubators also they will then have two thoughts to invest in you, right? Even at pre-revenue stage, at ideation stage, they are ready to fund you. You should be thankful to them that whatever valuation they are giving, right? Generally we have seen that at 5 to 8 crores at that stage we do valuations, right? So that we understand that you are not diluting high, right? And you are still going to the next level, right? Then the next level is that once you have all these funds, at least try to achieve some revenues. It may be up to 1 crore rupees, right? If you are into B2B side, you have at least 10 clients. If you have B2C clients, B2C model, right? At least 10,000 orders or something you have clicked. Again, at that time, go for raising of funds, right? At that time, you might have 15, 20 crores or 25 crores as your valuation, right? And see, again, don't think that you should raise your entire capital amount that you need for the entire journey at one go, because that will dilute you very high at the initial stage, right? So always try to break it up. I always suggest 12 to 18 months of runway should be good enough for you to go to the next stage. This will also help yourself as well as the next investor to understand that yes, he has achieved certain milestones, what might have been committed, right? And now you are coming back to me for further funds. So it also proves that it is not just talk, but you have also walked the entire journey, right? So it is always better to break your entire funding requirement into multiple stages, right? And it in fact finally it helps you because it will help in lower dilution, right? Initially, you if entire funds are getting clocked in the initial days only, you will be having a very high dilution because the valuation of your company will be very low in the initial days. So try to break your entire journey of cash flow requirements into multiple stages and then raise capital in these stages, right? Similarly, if we have crossed the 1 crore mark, right, and all these stages of 10, more than 10 B2B clients, more than 10,000 B2C orders, then we will start evaluating you much more seriously on your projections, on the market multiples, right? We will try to do some combinations of that and we will arrive at a value. At that time, then there is, I mean, the valuations can be as low as 30, 35 crores and it can go even upwards of 100 crores because you have achieved, it is a very big, I will say, hurdle to cross the 1 to 2 crore revenue mark. It seems it is not very easy as it sounds, right? And similarly, after 2 crores, from 2 to once you cross the 50 crore mark, again, it is a very difficult hurdle there. Once you are crossing 50 crores, you are almost as at a semi-mature stage. And then, I mean, then in fact, instead of VCs, there might be PEs who might be looking at you, right? So at mature companies, there will be always a combination of all the methods which we discussed, right? That will be majorly coming out to play. So these are some practical valuations which we feel you should be valued at as a company at the based on the stage where you are at, right? Then let's touch upon for compliance also. Once you have raised the capital, you will have to do compliances for which again you will need a valuation report. There are three compliances predominantly. One is as per Companies Act. You will have to do a filing that whenever you are raising funds, you will have to inform the ROC and the Ministry of Corporate Affairs that this is the amount of funds that is coming into me. Out of this, this is the price per share at which I am going to raise funds, and that is why that price per share has to be valued by a registered valuer, right? So there are different people who can value you. So a registered valuer is someone who is registered under the Insolvency and Bankruptcy Board of India. So there is a very tricky and a difficult exam in order to clear that. So Companies Act has recognized only them to do the valuation exercise. Next comes income tax. So income tax, there is basically a base value that below this value you cannot sell your company. It is basically the NAV value which we first saw, the first method. So in this again, if you are raising CCPS or CCD, you might need a chartered accountant or a merchant banker. There was once upon a time till last year there was angel tax. Luckily, it has been scrapped now. So now there is no more a valuation requirement there. That now under income tax there is only one valuation report, that is under section 56 to 10 is what we say, that has to be done only by a CA or a merchant banker. And the third is for FEMA, because very important today, most of the funds and NRIs and all of our friends who have gone abroad want to reinvest in India, right? And it is a great sign. In fact, out of every 10 deals, I am seeing minimum 4 deals wherein foreign capital is involved, right? So valuation has to be done again as per FEMA Act. That is, the report goes to the RBI. Again, they say that there has to be a minimum value below which you should not be valued. For this, there are many methods been prescribed. Generally, we use DCF method only, and the person who is allowed here is a chartered accountant again or a merchant banker. And here there is one more tricky part, that your valuation report should not be older than 90 days. And that is why we always say and suggest that whenever you are doing your report for compliance, right, try to it has to be as near to your cutoff date has to be as near to the transaction as possible, so that all the three reports can be complied with ease, right? So what are the documents that you need to submit to a valuer, right? So the first and most important thing is your shareholding pattern. A very critical thing nowadays in shareholding pattern is always check for ESOP clauses. Whenever you are going to raise funds from incubators, from venture capitalists, they will probably have an ESOP clause which you should have upfront. That means they don't want to get diluted into ESOPs. Very necessary for incubators and for venture capitalists, because they know that without ESOPs you are not able to go ahead, because nowadays all the senior hiring is not happening without ESOPs. So very critical for you to always add ESOPs if at all. If it doesn't matter that you have created one, right? The only thing will be the venture capitalists or the incubator will insist upon. So whenever we are doing the calculations, your entire shareholding, if it is 10,000 and they are saying 1,000, they need 1,000 ESOP pool, then total shareholding that has to be considered for the valuation report has to be 11,000, right? So shareholding pattern has to adjust for ESOP loss if there is any. A valuation date, provisional financials, I told you this has to be as latest as near to the transaction as possible. This will help for all the compliances. If you are a mature company, then historical data for last 5 years. This helps us to understand what has been your economics of costs of and working capital in all of these years. Projections of the company. One more thing, very critical. Uh, Generally always whatever projections we get is yearly, but whenever you are submitting and even evaluating for your own internal use, try to do it on a monthly basis, at least for the first 12 months, because in the first 12 months it is going to be very much ups and downs, and you should know exactly, because at the end of the year your cash might be positive, but during the year, in the midst of the year, there might be negative cash flow months, right? That you will understand only if you are doing a projections on a monthly basis. That is why we always suggest the first year at least. We understand you are not going to be able to project properly after the first year or the second year, but at least the first year do a monthly projection. You will understand how your revenues are going to flow, what your costs are going to be in that months, and how your money is going to actually come in, right? So monthly projections very critical. And of course your pitch deck of the company as to what is exactly that you are going to do and which industry you fall into, and some idea and understanding of what products and business model you are going to do. So these are some documents that we as valuers will always want from you guys, right? And finally, these are some more topics which I always like to take along with valuation. It's a small thing. It's one is what is pre-money valuation and post-money valuation. Always, this is a question always being asked by a lot of things. See, whenever a valuer does a valuation, he will always give you a pre-money valuation. For example, I have given you a pre-money valuation of 8 crore rupees. And if the investor is going to invest 2 crore rupees, your final post-money valuation will become 8 plus 2, 10 crore rupees, right? So it is a very simple jargon. However, sometimes it's confusing also, because whenever we see reports or anything, articles, they always give post-money valuation, right? However, whenever we as valuers do, we always take pre-money valuation, right? Then there is something known as CCD, CCPS, and equity shares. Equity shares is the standard. Yeah, equity shares is the standard, instrument. However, if you see CCDs and CCPS are nowadays the most commonly used instruments by all incubators and all investors, because it basically safeguards them for two reasons. One, sometimes valuation is not attained between the two. At that time, CCD plays a very important role. And CCPS is basically they want a preference shares, so that in case of liquidation, they get a priority, and only after that the equity shares get it. So that is the basic reason why CCD and CCPS is always done. Then we have the term sheet. Term sheet generally incubators they have very minimal terms, but if you go to VCs, even your salary is being guided by the VC, right? It is not that okay, I have got $2 million in my account. Let me take 50 lakh rupees as salary. No, they are going to even write what you as founders can draw maximum salary. So term sheet is basically a binding sheet wherein all you founders will be bounded, right? They are only bound by one thing, that is the price at which they are going to invest. All other terms will be binding on you as founders, right? It can be even like you will not be able to sell your shares to any third party. They will have a right of first refusal, all of that, right? So term sheet is something which will basically bound the founders, and that is why it is very critical to read each and every line of it and see what are you going to. It might not be that much negotiable because that may be a standard sheet. However, if you feel there are certain terms are not in line with what you had thought about, you should always discuss it out upfront instead of you thinking of having it as a surprise later, right? Legal and financial due diligence. So legal due diligence is basically to understand if there are any cases or anything that has been done by any third party on you, or have you done all your compliances properly, right? So that is why legal due diligence has been done. Financial due diligence is done in order to understand historically whether whatever money has been brought, has it been used wisely. or has the promoters taken away all the money, in any nature, right? Secondly, also a lot of times financial due diligence is done on the projections of the company. So they will even have a external party know whether whatever projections you are throwing to them, are they sounding proper, or it is not as per industry standard. So that is why also financial due diligence is done. ESOP pool, as we discussed, right? All incubators and VCs will want you to have, the range is nowadays minimum 7.5 to 10%. Minimum ESOP pools is what people always require. Finally, there's a share transfer and a share issue. What is the difference, right? So as I told you, nowadays all IPOs are offer for sale. So that is transfer of equity shares. Transfer, whenever there's a transfer of equity shares, the company doesn't get any money, right? Because it is between two individuals. The money directly goes from one party to the second party. For example, a lot of times you might have done incubation equity wherein you might have transferred the shares, right? You might not have issued new shares, because it is easier for the incubator also to directly take shares from you instead of issuing shares from you. And what is share issue? Share issue is basically wherein the money actually goes into the company, right? So whenever you are raising funds, right, that is when there will be new shares will be issued by the company, against which you will pump the money into the company. So these are some jargons and clarifications which I always like to take along with valuation. So I think that's it from my side. I hope I have been clear enough, and I hope I have been able to justify the time each one of you might have invested. So I am open to questions if at all, and my coordinates are also here in case anyone have further doubts. You can always reach out to me. Thank you very much.
Thank you, Arpiji. Thank you for your time. Uh, we have learned a lot. The whole incubator team and as well as the startups that have joined. I have been receiving SMSs from people for the sheet and the PPT. So if we have your permission, we can
Yeah,
share
yeah,
it
absolutely.
with
Please,
others.
both the Excel sheet as well as the PPT, I will share it with you. You can please distribute it to your entire fraternity.
Thank you so much. Acha, and we have also been getting some messages for your contact details.
Yeah,
Uh,
so I think that I have put it
that
across
we
here.
have
So yeah.
already. Acha, and startups are asking if there is a by the hand method where because at this they're at a stage when where they don't have as much funds or they are not planning to do the investments right away. So is there a hand method where they can identify an average valuation for themselves?
So as I told, see, the best way is one, always try to have a runway, right? One is you should not be, cash strapped, because even we as finance guys, we always want entrepreneurs to not think much of fundraising and actually do the entire operations and everything, right? So one, you should always raise capital for at least 12 or 18 months. With respect to some understanding, as I had showed, right, that basic, if you see this slide, some basic thumb rules, if you see that even at ideation stage, I mean, you guys, I mean, as incubators, you are all angels, literally, right? That you are valuing even idea stage companies at 5 crore rupees also. So the companies who are at least having a good team, who are having good ideas, validated some ideas, having some TRL 3 or 4, right? And they are having some patents. Why not? I mean, we will always value at 5, maybe even at the upper end at 8 crore rupees, but 5 to 8 crores is the general range wherein incubators will invest in that. VCs might not come at pre-revenue stage. There are some VCs, however, but even if they come, they will also value you roughly around 5 to 8 crores only. So this is the general thing. Whenever, if you are at ideation stage, at pre-revenue stage, this is a thumb rule. You can take it as a thing.
Acha. What are some basic compliances for OPC companies?
So OPC companies are finally just like private limited companies, right? So however, there are some I will say very small uh, compliances which are not there other than private limited companies. So if you see, as a private limited company, you have to do yearly filings of your accounts. You have to do a statutory audit, right? You will have to do whatever debts you have raised, you will have to put that also. The only thing there you don't have to do, because you are a one-person company, is you don't have to share your shareholding pattern, right? Because even they know that you are only one person, right? So only that is lean away a bit. But here I will want that person to understand that it is better to be an LLP or private limited, because generally funds will not be raised in an OPC company. LLP also not. If you are actually keen on raising funds, it's better to be a private limited company.
Okay. Thank you. How do we treat grant and aid on the balance sheet? And will that affect the valuation of a company? Because we have startups who have raised more than 2 crores in grants, and there are even funds with us that go up to 15 crores. So will that affect the valuation of a company or not?
Absolutely, it affects. See, whenever you are getting grants, it is basically, as I said, it is one of the method of raising funds, right? The good thing is it is totally non-dilutive, right? So the way to be presented, actually, if you see accounting standards, which applies to us as chartered accountants, actually grant should be treated as revenue. It is, because it is very specific purpose for which it is being given. For example, product development. So it is revenue minus that expense, right? So you will put the amount of expense which has been done, matching amount of revenue will put, and rest will lie in the balance sheet as a liability. So basically it has to be a revenue, it has to run through the P&L item. With respect to impact on valuation, it has a considerable impact, because of these grants, you are able to reach at a particular stage which you would otherwise might have not, right? So you can even, for example, if you have raised grant at the pre-revenue ideation stage, and from that, if you are able to, go to the next stage with the help of that grants, the valuation straight away increases from that 5 crore to 15 crores, right? Because already you have reached at a particular milestone and you are taking off from there, right? So it is very, I will say, first, always go for grants, whatever are available, right? Reach at a particular stage. And after that, if grants are no more available, only after that, go for dilutive capital.
Okay. Thank you. Acha, and is there an expiry for the valuation report? Because some startups get their valuation report today and they might raise funds after
So
6 months.
generally, as an industry practice, right, 6 months is what we always say. That 6 months is a general practice after which you will have to go for a new valuation report. So though legally there is no such thing, except in FEMA. FEMA has very clear 90 days, but otherwise legally there is no foundation. But it has been an industrial practice across the board that if your 6 months has expired, everyone will go for a new valuation. And it is better also, because in 6 months, startups entire thing changes, right? So it is always better to get yourself revalued after 6 months.
Thank you. There is another question. Is it better to be bootstrapping than approaching an incubator?
If you have the funds, bootstrap is the best. Look at Nitin Kamath, right? I mean, why not? See, it is as good as saying that, why to see. I already told you, right, that you spread your entire fund requirement across various stages. The reason is otherwise you will get diluted early on. So the more delay you can do for your dilution, the better it is, because higher your valuation will be, right? So always try to build a particular thing, right? If it is possible for you to bootstrap. Sometimes, however, we suggest venture capital money. The reason is certain times the approaches, the seriousness, the industry cracking, the networks which the VCs might be able to provide, right? That might not be possible for you as a bootstrapped company. So you will have to weigh that if you feel, if I am able to raise fund, right, and if I am getting some more networks, see, because venture capital is, they are going to literally sit next to you, right? I am seeing a lot of venture capitalists nowadays, all the monthly MISs, previously they used to not take it that seriously, but now everyone is very serious on that monthly MIS, right? So they will be taking all that monthly MIS from you, understanding what has gone right, what has gone wrong. So if you are able to do answering to them, right, then VC is good money. They can sometimes they will even take you to the next level and next round, because finally usko bhi exit chahiye, right? So they will only make sure that you are valued higher the next time, and that is why they will push you for that. So sometimes if you feel if you are not that self motivated, right, then VCs are a better place to go. Otherwise, bootstrapping is best because it is anti-dilutive, non-dilutive, and you raise the funds only when you actually need them.
Okay. Thank you. So we have another question here. Should the funds from shareholders or founders be treated as an unsecured loan, or is it advisable to increase it in the paid up capital?
See, the only advantage you have to keep it in unsecured loan is that you can take it back, right? However, if you are going to raise funds, right, generally investors will not allow you to take that money back, right? Because he will say that finally you are using my money to take that entire money back to yourself, right? So we see a lot of times wherein that loans are converted to equity, or sometimes the loans are taken back and again brought in back as equity. So it is always best to convert it into equity. Till the time VC or some other funds is not coming, it is okay to be shown as unsecured loans, so that you can have that flexibility in case you need that funds back and your company is able to give you that funds, you can take it back.
Thank you. So we have another, I think, very good question. I also had the same question. What are the methods used to value an IPR? Because there are a lot of startups who have good patents in their pockets and going for their scale up funds. So they need to get their valuations done. So how do you value an IPR?
See, the IPR valuation is certain things in which, it is basically first we have to understand what particular technology that particular person has built, right? How is it going to disrupt the market, right? And whether it is actually going to disrupt or not. See, what happens, most of the times technology guys will always think that I have created something amazing, beautiful, no one else can replicate this, right? But the hard truth is that if there is a Microsoft, there is a Google, there is a Bing, so something like that. So by small tweaks, you are always going to be, outplaced, right? So IP by itself might not have that high value. What is more valuable is the ability to execute that IP into a commercial product, right? So that is why, even I always say to a lot of technology companies, we respect you that you have built some amazing IPs, you have so much research has been gone into all these things. But what about commercialization? Because that is finally, commercialization is what will bring value. And second thing is disruption. If you feel some other company is going to get disrupted because of this particular new IP, right? Then might be that particular company might only buy you out straight away, right? So sometimes we see a lot of technology transfers, we see a lot of IP being bought out that are majorly being bought out, but I have not seen they being bought out at very high figures. They are generally bought out, I mean, maybe in few crores, if not lakhs, right? But it is not very high amount. And the reason is that only because the execution capacity is always going to overtake your only research, right? Because certain times we have in fact even seen, though there are IPs, but when you actually take it to commercialization stage, that thing entirely doesn't work, right? So if you see IPR standalone, it is okay. I mean, you can take the entire market size, try to do TAM, SAM, SOM, right? And then maybe, put some fraction to it. However, recently I have seen so many investors, critically declining that please don't use the TAM, SAM, SOM method because it is not advisable, especially in a country like India, right? It is better to go bottom up approach, right? Wherein you are properly understanding as to who you will meet, how much sales you will do, how you will do that, how many foot on ground you will have, right? And accordingly, you will do your entire sales understanding. So finally, you will have to put some value, in order to give the valuation of the IPR, you will have to give some understanding of either what it is disrupting or how much commercialization revenues it is going to bring.
Okay. We also have a follow-up on this question. So, will a patent, filed patent be how will be a patent pending will be treated in this scenario?
So filed patent, and as I told you, filed patent, definitely someone who has already received the patent and everything will have, I will say, 20-30% higher value than just a filed patent, but not much difference.
Not.
Not much difference.
I also had one question. We have seen some founders who get their valuations done from a certain person, then they go, but they do not raise funds at that point, but they move on to take that valuation for some shopping to other investors, other VCs, and then they don't get that similar valuations. So what is this called and how to avoid this?
See, for example, like, even I get a lot of times, companies who already have done valuations. Honestly, I will just look at the basis, right? At what basis that, because see, he will be my counterpart only, someone who might have done the valuation, but he might have done it in a different scenario. He might have done it in a different understanding, right? When it comes to us, I will definitely look at what are the assumptions he has used, right? And what are not correct according to me, right? So I will use my own judgment, right? I will try to analyze it. If he has done something correct, I will even take the same assumption also. I mean, it is not wrong to do that, right? However, I have seen generally founders are always guiding the valuers that, I need some valuation around this, and that is where the entire thing actually doesn't work, right? That if I am an entrepreneur, I am going to a valuer, अरे यार around 30 crores के आसपास का valuation बना के मुझे दे दो, right? So that is where it happens. That is where the entire things go for a toss, right? Because the assumptions are only made in such a way that it is automatically going to give me a 30 crore valuation. Because finally, certain methods like DCF and all, they're all arithmetical methods. So it is what is GIGO, garbage in, garbage out, right? So it is like that. So that is why we will understand similar companies, what are they doing, whether the EBITDA, we get certain times EBITDA percentage is as high as 65%, 70%. Might be true for certain industries, but 99% of the industries don't have such high EBITDAs, right? So we have to understand all these things and accordingly do the discounting of the numbers, right? And window shopping, वो उनका हक है, वो करेंगे, but ठीक है, but I will actually discourage that. As I said, आपका खुद का ये सब एनालिसिस करके you come out at a price and have a 25-30% upside to that whenever you are quoting, right? Don't do a 200%, 300% upside, because that will just make other people go off the table. So that is my advice to them.
What is a down round? We have seen startups raising funds at, let's example, 10 crores. Then in the next round, they raise funds at lower valuations.
So this is the basic reason, right? Like I told you, for example, if someone is coming to me with a 30 crore valuation and I agree to it also, for example, right? And suppose tomorrow he goes to another VC and he is giving only at 20 crores. The person who is going to lose is actually the founder, because there will be an anti-dilutive clause which will be there in the shareholder agreement, that if there is a down round, that is if my valuation was 30 and now it is 20, I will be eligible to get that I will be compensated for that many number of equity shares, right? So if you have seen recently a very big company known as PharmEasy, right? They had a significant down round. Byju's again, significant down round, right? What happened? The other investors eventually took over the entire company, right? So the founders are then left with like 2% or 3% or even lower than 1%. So that is the basic reason I always tell them that please don't exaggerate your valuation so high that the next round, right, is going to be a down round. So always be in certain metrics. ठीक है, अभी आपने 15 पे किया, नेक्स्ट 20 पे किया, फिर 30 पे किया, अंडरस्टैंडेबल. आपने सीधा 50 पे किया, दूसरा 10 पे किया, it is going to only harm yourself, not the investor. The investor will always have a protection clause of anti-dilution. That is why down rounds are very tricky, and founders should be very understanding of what valuations they are actually pitching at.
And is there a minimum investment amount fixed with the valuation, which makes investment round legit? Because we've seen founders who can get valuations of 100 crores and they raise 1 lakh, 10 lakh, 20 lakh rupees, and they get that valuation because uh,
So generally, if you see, whenever even in clauses, we always say that minimum. If generally a big round is known as at least 3 crore rupee round, right? A 3 crore rupee round is certain, wherein the person who might have invested 3 crores or 6 crores has done a thorough diligence, right? That is why it is called as a full round, right? If you are raising 1 lakh, 2 lakh, 5 lakh, 20 lakh, 50 lakh, doesn't make a round. Actually, that valuations are generally okay. Only angel investors are investing at that rounds, right? So it is okay. And if it is at a very initial stages, again, they as angel investors also, they will also not invest at a higher valuation. They will also invest at pre-idea stage roughly around the same 5 to 8 crores. If you have gone somewhere above the same 15, 25 crores, they are not going to invest. Today, investors have become very smart. So don't expect them to invest at a very high valuation. If you have already achieved something greater than all these numbers, then they will be able to give you a better valuation. Otherwise, generally around we always call, in fact, minimum $1 million as a minimum round, right? But otherwise, I have seen term sheets even having 3 crore or 6 crores also have minimum round. So that is a normal thing in term sheets.
Thank you so much. So we have a question from one of our participants. Are convertible notes better than CCPS or CCDs? And which agency valuation certificate are well known globally, which can attract investors?
So there are no agencies as such. You can take valuation report from the big fours like Deloitte, Ernst and Young also, and you can take from someone who has just started also, and someone who is doing regular practice also. Finally, the person who is investing is going to do his own due diligence. He is going to do his own valuation. He might take it, as I said, like even we do. He might take that report, read it, understand what that valuer has done. That's it. Otherwise, for him, it is nothing else. He is going to do the entire exercise again, right? So there is no, I feel you should generally avoid a valuation report taking upfront, right? It is better. You all these exercises, if someone is helping you with that, then it is okay. But otherwise, you don't need a full-fledged report other than that for compliance, right? If you want in-house, then ask him to do it properly. Ask your valuer to do all these things properly so that you get a proper understanding of where you are. Otherwise, if you are not giving him with proper numbers, in fact, we always recommend whenever someone comes to me, I first take the assignment of financial modeling. That first let me do your projections proper. Only then I will do your valuation in a bit, because valuation is going to be a derivative of all the projections, right? So first important is you do your projections much more thoroughly, right? Only then you understand what your valuation is going to be. I think there was one more question in that. What was that?
Are convertible notes better than CCPS or
So
CCD?
convertible notes in India are not very much widely used, right? It is because it is not easy to be governed by laws. That is the reason CCDs is a much more prevalent thing, right? In India, convertible notes are not that prevalent in India.
Okay. I think we are done with most of the questions. Some startups are asking for you to review their projections and they
Would
want
be
some.
happy to do some. Definitely not an issue. Yeah.
Okay, great.
Yeah.
And some of them are asking for Excel sheet where they can just fill in and get some idea of their valuations.
I think I will check the
Awesome.
Excel sheet which I have sent. I will
Hmm.
check if that can serve that purpose. Or I will send another sheet which can also serve that purpose.
Sure. Okay, definitely. Uh, Thank you so much, Arpiji, for this session. We have learned a lot. SIC team has learned a lot. startups who have attended, have learned a lot. Thank you for your time. For all the participants, please follow RPG on his LinkedIn. If you want, you can get in touch with him on in the email ID that is given on the screen right now. Thank you so much for joining, everyone. Thank you, RPG, once
Thank
again.
you. Thank you very much to the entire SIIC team for having me on for this webinar. Thank you once again.
Thank you so much. Bye-bye.